you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. So 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine. You're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines.
We all know Warren Buffett, but there is another stock market legend, Peter Lynch, a former US fund manager who created huge wealth for his investors. He shared a simple yet super effective way to create wealth in stock market. He says that some of the best stock investment ideas come from the products and services that we use in our daily life. So just find out your favorite brands and ask, can you become a part owner in your favorite company? For example, we all use products of Apple, Google, Amazon, Netflix, Facebook, Microsoft on a daily basis. Doesn't it make sense to become a part owner in those companies? Now you can also invest in US stocks from India via SIP using IND Money app with as low as ₹500 without any commission, brokerage or fees. When you sign up on the app with the link in the pinned comment, you'll get free Apple shares worth ₹750 on your first US account funding. So check out the link, fund your account and claim your free shares now.
Well, it bothers me that people are very dangerous when they invest. This word play the market, that's a dangerous term. But if you do some work, do some research, know what you own, look at the research, look at the balance sheet. You could add 8 and 8, get fairly close to 16. You can find out this company has lots of debt, no cash, they're in trouble. You shouldn't own it. So a little bit of research. People are careful when they buy a refrigerator, careful when they take a vacation. And they'll put $5,000, $10,000 some stock to hear on the bus or at a party. That's dangerous.
Well, I think the advantage of putting money into a retirement fund, obviously a Fidelity fund I would prefer, but index fund, whatever it is, put some money aside. It's going to compound tax-free.
Yeah.
Start saving early. The numbers are amazing.
Compounding will do wonders for you, won't it?
But until you want to invest directly in individual stocks, start a paper portfolio. Say, I'm going to buy these 10 companies. And then write down in like 5 bullets why. What's the reason I bought those? And then keep checking a year later, what happened? Did they really keep growing, or did a competitor come along? Do a paper portfolio, and you can do exactly what I did with a real portfolio and find out, what am I good at? What am I bad at? Am I really good at turnarounds? Am I good at small growth companies? Maybe I pay too high for stocks. You can do this over 4 or 5 years and learn what's your skills, and then specialize in that. I had owned thousands of companies. You know, the average person, all you need is a few in your lifetime.
Yeah.
Make a difference.
The stock doesn't know you own it. Remember that. You could be a miserable person. You could have, never helped anybody, never done anything right, had 67 spouses, never done anything right. If you own Coca-Cola the last 50 years, it's gone up 300-fold. You could be the greatest human in the world, help Special Olympics, help the mentally challenged, help poor people, help AIDS people. If you own Bethlehem Steel, it's lower than it was 30 years ago. It's not your fault. Don't take this personal, But people treat stocks sometimes like their grandchildren or a puppy. I mean, they think the stock knows who you are. It doesn't work that way. There's always something to worry about, and the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8 and get reasonably close to 16, that's the only level of math you need to know. You don't know to need the area under the curve. Remember that quadratic equation and an integral calculus and the area under the curve? I mean, whoever cared what was under the damn curve? I mean, but you had to study this. You don't need this in the stock market. So all you have to know is you're going to see it's always going to be scary. There's going to be always something to worry about. And you just have to forget all about it. Cut it all out and own good companies or own turnarounds. Study them and you'll do well. And that's all there is.